Welcome back, everyone. In this video, we're going to talk about budgeting. First, why do you need a budget? A good budget will help you with a lot of things. First of all, it will help you live within your income, spend your money wisely. Most importantly, for the purpose of this class, it's going to help you reach your financial goal. In addition, we can help reduce your financial stress. By having a budget, you can be better prepared for any emergencies, both life emergencies and financial emergencies. And then by sticking to a budget, it'll help you develop healthy financial habits. The good news is, at this point, after you have created your statement of cash flows, you're already 80 to 90% towards creating a budget. So the first thing you need to do to create a budget is to use your statement of cash flows to estimate what your future income and your future expenses would be. As a rule of thumb, you want to use the entire year, so over the past 12 months, so that you can again capture those changes from month to month, including holiday spending and so forth. You can convert the annual numbers to monthly by dividing it by 12, because a lot of us think of budget as a monthly basis. We don't think of how much our rent is per year, but how much our rent is per month, our monthly car payment, and so forth. Another good things that you can do to make your life easier is to use round numbers. You don't have to be precise when you create a budget. This is a roadmap. You just need to go towards the general direction. So for example, if you find that last year you spent $1,358 eating out, round it to $1,400. The most important part of creating a budget is to incorporate any new information that you know. For example, if you know you're getting a raise, include that in your income, or if you know that rent is going up, adjust your budget to reflect this new information. The most important part and the most useful part of a budget is by seeing the potential future roadmap, you can then make necessary changes. For example, in order to reach your financial goal, you may need to reduce your spending, or you may need to make more income. And if this is something that, let's say, is important, you may even have to consider taking out a loan. For example, if you're buying a new car, then you may need to take out a loan, and then you need to incorporate that new car payment into your future budget. Don't be discouraged. Nobody gets the budget right the first get-go. Usually it takes a few rounds in order to get a budget. Once you have figured out and make the necessary changes to your spending and your income, you then allocate any cash surplus towards your financial goal. As a tip, this is a good idea, is to set up automatic transfer in your bank to put your excess cash or surplus cash into your savings account or your investment account before you have a chance to spend it. You may hear the term zero-based budgeting. It simply means that instead of assuming past expenses will automatically be the same next year, you are asked to reassess each spending category to find out what it is. Zero-based budgeting is a valuable technique to use for optional spending categories. Not for essential spending categories such as rent, utilities, and so forth. It is more useful to assume that the past will be the same, such as utility, and if you know of any possible increases. One approach would be to just assume that utility is going to go up 3% or 5% per year based on past experience. Zero-based budgeting are most useful to question, do I still want to keep a particular streaming service? For example, you had a streaming service last year. Do you assume that you will budget the same for next year? Or should you evaluate, do I want that subscription service again next year? So this is the question that you typically ask when you are evaluating or adjusting your budget. So zero-based budgeting is a useful approach, particularly for optional expenses. Now that you have created a budget, we need to use it. So to use a budget, you need to record your actual income and spending. If you do not do that, then the budget will just be a piece of paper sitting around, or a file folder, or a file floating around in your computer. When you compare your actual income and spending versus the budget, you can determine what is the difference. So the difference is sometimes called the variance. No one will hit the exact dollar amount in the budget. The key is to see how far off you are. And then you can review your spending and saving pattern. You may want to do this every month or every quarter, at the minimum once a year. Here are some important things to remember about budgeting. You want the budget to be a useful tool for you. For that to be the case, you need to be realistic. You're going to get a reality check when you compare what your actual expenses or income are versus your budget. So you may be very optimistic, but if you cannot adhere to the budget, then it's not useful and you just end up being discouraged. You want to set a realistic budget that you can feel good about. The other thing is that remember the seasonal variation. So when you take your annual number and divide by 12, particularly for things such as gifts, you may find that in March and April you spend hardly any money on gifts because most of your family members have birthdays in September and October. So you'll find that all your gift expenses happen in the second half of the year. And that's why when we compare the budget versus our actual spending, we need to take that into account. By keeping track of your actual spending, you'll also be able to capture unexpected expenses such as car repair, medical expenses, and so forth. By extending a monthly budget to the annual, meaning at the end of the year, you do a yearly checkup to compare how your spending over the entire year was compared to your annual budget, and that will give you a more complete picture. So here are their adjustments. So first is the income portion. This is their monthly income last year. The gross income was $10,500. We know they're going to get a 5% increase. So their budget amount will be increased by 5%. So that's adding $525. Notice that the income will also be subject to tax, so the deduction will also increase. So their new take-home pay each year will be each month will be $8,265. We know that the budgeting is going to take multiple rounds. In the first round, we put in the known changes. So for Maya and Isis, they don't have any known changes for expenses. The only known changes they know are their income. So we increase salary, and we also assume that deduction will increase by the same amount. For all the other cash flows, we do not have any known changes. We just simplified them. So let's take a look at that. The goal of the first round is just to check and see if there will be sufficient cash surplus for Maya and Isis to reach their goal. Here are the adjustments to the income that we have seen before. Next, what do we mean by simplify the other cash flow? Simplify simply means rounding them up. So instead of $2,461, we round it up to $2,700. Grocery was $973. We round it up to $1,000. We do the same for all the other items. And we saw that simply by rounding up the other expenses, right now their current budget has a deficit of $35 per month. So the new take-home pay, even though it went up, based on their past spending, that is not sufficient to cover the expenses. So our conclusion after round one is that more changes are needed. So in round two, we're going to make changes to spending and income to move towards the goal that they have set. A lot of times the first change that people make is to reduce your spending. So let's take a look at their spending to see where they spend most of their money. If you look at their discretionary, meaning optional expenses, the eating out is 7% and leisure was 16%. So those are the two primary targets that they can look at in terms of what they can do differently. For essential expenses, there's not a whole lot of room, but there are some options. Maya and Isis decided that they want to reduce eating out and leisure. So they increased their food and grocery budget to account for eating at home more. They also shop for cheaper alternatives in car insurance, and they were able to do that. So let's take a look at their round 2 budget. So in the round 2 budget, they make the adjustment that they hope to be able to achieve their goal. They were able to find cheaper insurance. They reduced their home insurance by $30 per month and their auto insurance by $50 per month. They're going to increase their food budget by $200 a month, and they're going to eat out less. They're going to cut their restaurant budget by $400. They're going to discontinue a lot of their subscription to streaming services. They cut their clothing budget, and they also cut their gift budget. By making this adjustment, now they will expect to have a $1,595, so almost $1,600 a month in terms of savings. Based on this amount, they assume they can contribute $300 a month to their emergency fund and $1,200 to their retirement. They will have a surplus of $95 a month, so that's kind of their, if they have any margin of error, that will be able to cover that. Are they able to reach their goal by making these adjustments? Let's take a look at their short-term goal. They want to have $25,000 in emergency fund within 12 months. They're currently saving $300 per month. That is not going to reach $25,000 in 12 months. Their intermediate goal is to have $50,000 for kitchen renovation. They currently are not contributing to it, and that was not in their budget. Their long-term goal is to save for retirement by saving 15% of their gross income. Right now, they're contributing $1,200 per month. Their gross income was $11,025, so $1,200 per month is about 11%. We can see that they are not meeting all their financial goals. What additional changes can they make? After reducing their expenses, the next thing they can do is look for more income. Isis is a teacher. She was able to find a job over the summer, and that will increase their take-home pay by $5,000 per year. That will allow them to have about $18,000 in emergency fund over 2 years. So $18,000 is a little bit more than 3 months worth of essential expenses. That's a compromise they are willing to take. They realized that they will not be able to reach their kitchen renovation goal, and they decided to postpone that goal. And this is the revision process that we talk about in chapter 1. As we go through the budgeting process, we may need to then go back and revise our goal if the goal becomes unattainable. They are contributing 11% of gross income to 401k. That's not a bad place to be. It is a huge improvement over what they were doing, which was nothing, and an excellent starting point. After you have created a budget, the real test is when the rubber meets the road is what is your actual spending compared to your budget. You may find that you have to make additional changes if that becomes necessary. Let's take a look at how Maya and Isis do. By working in the summers, Isis actually make more money than they originally budgeted. So when you have a variance in your income, that's a good thing. So they actually make almost $8,000 more in the year compared to what they originally planned. In terms of their spending, they were able to keep to their budget in most of the categories except gas. So they spend more money on gas than they planned. A happy surprise is medical expenses. They have been healthy last year, so their medical expenses was much lower than they originally budgeted. Discretionary spending, they try and they did a good job. They underspent in the leisure category, but they were still eating out more than they had originally planned. But overall, they spent $640 more than they had budgeted. But overall, they did a very good job, and they were able to achieve their goal. They have a cash surplus, and their cash surplus is much higher than their budget. And also they were able to allocate a lot more money to the emergency fund, so they have $15,000 after just 1 year. Keeping track of expenses is important, but it may also be a challenge. The good news is there are many tools available to help you. You can create your own spreadsheet. This basically involves downloading the information from your credit card. Every month, you don't really have to keep track of it every time you spend money. A lot of banks and credit card companies also have their own tools. They allow you to track expenses. They even allow you to group expenses into categories. Some of them even have limits that you can set that send you alert messages when you spend more money than you had set in that particular category. So these are tools depending on what credit card or what bank you use. They have different tools. Spreadsheet is relatively easy to do. You already had a chance to play with some of the tools that we see in here. You can also download third-party apps. There are quite a few of them. The things that you want to consider and to trade off is privacy, security, how easy it is to use, how reliable, and also does it cost money. For do-it-yourself, it's a little bit more work, and it's up to you to maintain security, privacy, and reliability. You do a little bit more work, but you could be very high in terms of security and privacy because you are the only one who have access to it. The cost is free. If you use tools from banks or credit card company, some of them are easier to use than others. Banks and credit card company, they have their own security protocol. They are as safe as your bank account. And most of them are also free. Apps from third party, most of them are designed to be user-friendly, so they tend to be easier to use. However, there's a large degree of security and privacy variations between the different apps. In terms of reliability, the biggest concern there is that the apps may not continue to exist. In fact, there are a number of very popular money management and spending tracking apps that discontinue, and then you have to find a new one to use, and you need to transfer the record over. The cost varies. They go everything from free to subscription-based. Again, if you are not paying for it, then you are the product. So security and privacy will be the highest concern if you're using a third-party app. To conclude, the reason why we create personal financial statements, one of the main purposes for this class and personal financial planning is allow you to monitor your progress toward your financial goal. Another added advantage is that if you ever need to apply for a loan, whether it be a car loan or a mortgage, banks typically require this information. So if you have your financial statements handy or keep it up to date, you don't have to panic or do extra work when the need arises. If you want to start your own business, this is also important. It's not just banks, but your suppliers and maybe even customers would want to see the information to know that they're dealing with a business and a business owner that has the financial resources to support the business. Lastly, something that is closely related to financial statements or financial records. It is important to keep your financial record in a safe place. This is included in the textbook. You can as well as download this. So for your personal information, particularly your social security card, your passport, you want to keep that forever. Employment, you want to keep that as long as you're staying with the same employer. Tax record, this includes your W-2s, your W-4s, your tax returns. The usual recommendation is to keep it for 3 to 6 years. Banking statement, you want to keep it for the most recent year. And as long as you are for leases, housing, or mortgage, as long as you owe the loan, and if you stay in the same apartment, you want to keep those as long as you live in that place. The same thing for car and major purchases. Keep those information as long as you own the vehicle or the appliance. For insurance, you only need to keep the most recent policy. And we'll talk about will and estate plan in a later chapter. If you have those, again, keep only the most recent version. Where do you keep them? For most of us nowadays, we keep them only online or in our computer. For most records, including bank statements, electronic copies are the easiest to keep. You want to download a copy and you want to back up the file. Make sure that you use encryption. And if you delete the file, make sure that you're permanently deleting it, not just erasing it. Organize them in folders so you can access them easily. You also want to have make sure that the passwords are secure. If you have paper records such as your birth certificate or your social security card, you want to keep them safe at home in a fireproof safe or in a safe deposit box in the bank. If you lose those records, it is very time consuming to replace them. This concludes the chapter 3 on budgeting and also financial statements. I'll see you in the next chapter.